Ray Dalio recently voiced a concern that goes far beyond a typical recession. In his statements, he referred to a severe economic crisis, already alarming on its own, being made worse by a monetary event. When these two elements combine, we shift from something like the mild 2001 recession to a situation more comparable to the 2008 financial crisis. And it's not the stock markets that trigger this shift. For instance, between 2000 and 2003, equities declined slowly, resulting only in the mildest recession ever recorded. However, 5 years later, the financial system entered a deflationary spiral that brought the entire economy to its knees. That's the key difference. The real threat is deflation, and that's exactly what Dalio is warning about. Recent moves in the U.S. Treasury market may be a red flag, especially since this is the second time in just 4 months that this pattern has repeated. Most people ignored the first signal, attributing the rise in yields back in December and January to inflation, the Fed, or other surface-level causes. But there are deeper signs pointing toward potential monetary deflation, which makes this moment particularly concerning. Even now, the economic environment is weaker than what's being publicly acknowledged. That's what's truly affecting the stock market. A sudden realization that the risk of a deep recession is much greater than previously thought, and the data continues to back up this concern. Just today, for example, a Federal Reserve survey revealed that the top fear among Americans is losing their jobs. The median forecast for unemployment reached the third highest level ever recorded. People are seriously worried about their employment and income, and this lines up with several other indicators. Dalio is right to stress that we need to take these risks more seriously. He draws attention to two main dangers: the recession itself and the monetary risk, which, when combined, could amplify all the negative effects and trigger additional knock-on consequences. But the outcomes Dalio fears might not be exactly the ones that end up materializing. He points to rising interest rates and a potential collapse in the Treasury market, which is directionally correct, but he may be looking more at the symptoms than the root cause. As for interest rates, we can already anticipate where things are headed, given the clear signals of deflationary risk across multiple fronts, from falling swap spreads to recent moves in assets like gold and copper. These are all signs of monetary contraction. When paired with a recession, they create an extremely negative economic scenario. So, Dalio is absolutely right to be concerned about this convergence of factors, even if he hasn't interpreted all the signals perfectly. Yesterday, in an interview with NBC's Meet the Press, he stated, "We're at a critical decision point and very close to a recession, and I fear something worse if the situation is not managed properly." He also suggested that Congress should cut the federal deficit to 3% of GDP, echoing statements he made at another event in March. If that doesn't happen, Dalio believes there will be a mismatch between the supply and demand for government debt, worsening the economic situation even further. The result, according to him, could be worse than a standard recession. We're talking about something that could challenge the very value of money itself. He mentioned that a combination of a collapsing bond market, internal social tensions, and external conflicts could be more damaging to the monetary system than Nixon ending the gold standard in 1971, or even the 2008 global financial crisis. It's worth remembering, though, that the end of gold convertibility in 1971 was more of a political acknowledgement than an economic rupture, since monetary imbalances had started well before that. What Dalio is really highlighting is that today's issues in the Treasury market could have serious consequences. He believes this could lead to higher interest rates, arguing that there will be a lack of buyers for U.S. government bonds. But, in reality, the problem isn't a lack of demand. It's the overwhelming volume of sales. This is driven by monetary tightening, which is also evident in the repo market and other financial segments. This liquidity shortage could turn a normal recession into something much worse. Not necessarily a repeat of 2008, but certainly something of similar magnitude in terms of severity and impact on the real economy. Just like in 2008 when, at the height of the crisis, interest rates spiked, something few remember because all eyes were on the stock market collapse and the Fed's actions. Eventually, rates dropped sharply and only rose again with some optimism the following year, before falling once more after the crises of 2010 and 2011. Even as public debt grew rapidly throughout the 2010s, the value of U.S. government bonds continued to rise. As much as we might wish for a different reality, this reflects an economy with a deflationary bias, and in 2020 the same pattern repeated. During the peak of the dollar shortage crisis, international reserve managers were forced to sell their U.S. treasuries, which in turn pressured basis traders to do the same, ultimately paralyzing the repo market. Interest rates spiked momentarily, but quickly fell again. By mid-2020, rates had reached historically low levels. Long-term treasury bonds were yielding at record lows. Yields later rose slightly during a post-pandemic wave of optimism, but only climbed more significantly when the Federal Reserve began its interest rate hikes in response to misunderstood inflation fears, confusing a supply shock with real inflation. In other words, we never truly faced problems due to bond sales themselves. Those sell-offs were actually linked to dollar shortages, something that also occurred in 2008. The real concern should be this lack of dollars, not just the act of selling treasuries. The issue is monetary in nature, not merely about interest rates. And Ray Dalio isn't the only one thinking along these lines. Many figures on Wall Street and in mainstream media are also worried about rising yields, yet almost no one is talking about the repo market or liquidity breakdowns in the monetary system. Recently, the Treasury Secretary spoke about the situation in an interview with Fox Business, on one of the days when pressure on bonds was particularly intense. He suggested that changes to bank leverage rules might allow banks to increase their Treasury purchases without needing as much capital, creating a new kind of institutional buyer. However, this sidesteps the more important question: why are these bonds being sold in the first place? The narrative that regulation is preventing banks from buying bonds doesn't hold up. In Europe, for example, banks under the same regulatory framework have had no hesitation in buying sovereign debt on a large scale. The difference lies specifically with U.S. treasuries. Those are the ones being sold, and few are willing to confront the reasons why. Dalio, even without pinpointing the exact root of the issue, at least recognizes the warning signs and understands that serious consequences are at stake. When we combine a deflationary environment with economic slowdown, we inch closer to the worst-case scenarios. Recession is already a growing risk on its own, but when paired with monetary stress, the effects are significantly magnified. The focus, therefore, should be on liquidity shortages, the fragility of short-term funding markets, and the dollar scarcity, not merely on nominal interest rates. It's this combination that can turn an ordinary slowdown into something far deeper and more damaging. That will be covered in the next video. Watch part 2 to find out the best solution to this commercial crisis and how to prepare for what's coming. Make sure to like the video and subscribe to the channel so you don't miss the follow-up.